Welcome to Joseph Markets, your trusted source for cutting-edge finance insights, where we uncover the trends shaping your wealth. If you're watching this, you're probably wondering about the whispers in the financial world. Are U.S. banks quietly stacking Bitcoin behind the scenes? Stick around because in this deep dive, we'll expose the facts backed by reliable sources, and by the end, you'll have a clear strategy on how this could impact your portfolio. For 100% true news and accurate advice like you'll get here, hit that like button, subscribe to Joseph Markets, and comment "Banks on Bitcoin" below. Let's discuss. This video key insights on U.S. banks and Bitcoin accumulation. Research suggests that while U.S. banks are not directly accumulating large amounts of Bitcoin on their own balance sheets due to regulatory constraints, they are increasingly facilitating Bitcoin exposure for clients through custody, trading, ETFs, and collateral services. This quiet buildup indicates a shift toward institutional integration, driven by regulatory clarity like the Genius Act and client demand. Evidence of involvement: around 60% of the top 25 U.S. banks now offer or plan Bitcoin-related products, such as PNC's direct spot trading and J.P. Morgan's acceptance of Bitcoin as collateral. Government role. The U.S. holds about 328,372 BTC in its strategic Bitcoin reserve, but this is separate from private banks. Controversy. Some view this as mainstream adoption boosting Bitcoin's legitimacy, while critics argue it centralizes a decentralized asset and competes with traditional banking products. Future outlook. Experts predict deeper integration in 2026, with more banks launching ETFs and lending, potentially driving Bitcoin prices higher amid volatility. Why this matters for investors. For everyday investors, this trend could make Bitcoin more accessible via familiar banking apps, reducing barriers like self-custody risks. However, it may introduce fees and regulatory oversight, altering Bitcoin's original ethos. Supporting data. According to River Research, January 2026, 15 out of 25 top U.S. banks have active Bitcoin services. Silicon Valley Bank's outlook emphasizes acceleration in VC investments and M&A, with stablecoins and tokenization as key drivers. For more details, see the comprehensive survey below. Let's kick off with a jaw-dropping hook. Picture this. While retail investors panic sell during market dips, America's biggest banks are silently positioning themselves to dominate the Bitcoin space, potentially controlling billions in digital gold. What if I told you that over half of the top U.S. banks are already building Bitcoin products, and some are even accepting it as collateral for loans? This isn't hype. It's happening right now, and if you leave early, you'll miss the shocking data on how this could skyrocket Bitcoin's value in 2026. We'll break it down step by step, with citations from top sources like CoinDesk and Forbes, so you know it's legit. Plus, I'll reveal a hybrid investment strategy that combines bank-backed safety with direct Bitcoin ownership, but only if you watch till the end. To keep you hooked, here's our retention roadmap. First, we'll explore the historical feud between banks and Bitcoin, then dive into recent regulatory shifts that opened the floodgates. Coming up, real examples of banks like J.P. Morgan and Morgan Stanley accumulating exposure, pros and cons for investors, and future predictions that could change everything. Every few minutes, I'll tease a key revelation, like the U.S. government's massive Bitcoin stash, to keep you engaged. Remember, knowledge is power in finance, so like, subscribe, and comment on Joseph Markets for more. Point 1. Understanding the shift, from Bitcoin skeptics to silent accumulators. Let's start at the beginning. For years, U.S. banks viewed Bitcoin as a threat, volatile, unregulated, and a potential disruptor to their traditional systems. According to Wikipedia's entry on the U.S. Strategic Bitcoin Reserve, banks were historically restricted by rules like Staff Accounting Bulletin 121, SAB 121, which forced them to treat customer crypto assets as liabilities on their balance sheets, effectively blocking widespread involvement. But fast forward to 2025, President Trump's executive order rescinded SAB 121, paving the way for banks to engage more freely. According to Wikipedia, this change allowed banks to custody digital assets without the previous burdens. This quiet policy flip is why we're seeing accumulation now. Not loud announcements, but strategic builds. Imagine banks like JP Morgan, once Bitcoin critics, now planning to accept it as collateral. This shift isn't accidental. It's a calculated move to capture the growing institutional demand, where Bitcoin ETFs alone hold over $130 billion in assets, as per wealthprofessional.ca's report on Morgan Stanley's ETF filings. Expanding on this, consider the broader context. Bitcoin was born in 2009 amid the financial crisis, designed to bypass banks entirely. Satoshi Nakamoto's white paper criticized centralized finance, yet here we are, with those same institutions dipping in. Why? Data from Silicon Valley Bank's 2026 Crypto Outlook, as summarized on svb.com, shows institutional adoption accelerating because crypto is moving from speculation to infrastructure. Banks see Bitcoin as a hedge against inflation, similar to gold, but with higher growth potential. In 2025, venture funding in U.S. crypto companies rose 44% to $7.9 billion per PitchBook data cited in CoinDesk. This influx means banks are investing in crypto firms or building their own services to stay competitive. For instance, a consortium including PNC, Citi, and Wells Fargo is exploring joint stablecoin initiatives, which indirectly boosts Bitcoin by integrating it into payment systems. According to svb.com, this is driven by the Genius Act, which allows banks to issue stablecoins under strict conditions. If banks accumulate quietly, it's to avoid market volatility, buying dips without spiking prices. This strategy could stabilize Bitcoin long-term, but it raises questions. Are banks co-opting a decentralized revolution? We'll explore that later. Point 2. Regulatory green lights, the catalyst for quiet accumulation. Nothing happens in finance without regulation, and 2025 was a banner year for crypto-friendly policies. According to Reuters, cited in Wikipedia, in March 2025, the OCC and FDIC announced banks no longer need advance permission for cryptocurrency activities. This removed a massive barrier, allowing banks to custody, trade, and lend against Bitcoin without endless approvals. According to Wikipedia, this directly ties to the U.S. Strategic Bitcoin Reserve, where the government itself holds 328,372 BTC as of February 2026. The Genius Act, signed in July 2025, further enabled banks to issue stablecoins, blending fiat stability with crypto efficiency. Per CoinDesk's article on SVB's Outlook, this clarity explains why banks like Societe Generale launched a euro stablecoin, and JP Morgan expanded its JPM coin to public blockchains. Delving deeper, these changes aren't just paperwork, they're economic game changers. Before, banks risked penalties for crypto involvement. Now, they're incentivized. Forbes reports in its February 2026 piece that regulators like the OCC are laying a friendly foundation for crypto, approving charters for firms like BitGo and Fidelity Digital Assets. This means banks can hold Bitcoin as custodians for clients, indirectly accumulating exposure through fees and services. Data from River Research, January 2026, as per earnpark.com, shows 60% of top 25 U.S. banks offering Bitcoin products. For example, PNC launched direct spot trading in December 2025, powered by Coinbase. Why quietly? To test waters without alarming shareholders or regulators. But the accumulation is real. Institutional Bitcoin ETFs saw $57 billion in net inflows since 2024, per Amina Group's 2026 Outlook. Banks are positioning for a $3 trillion institutional capital unlock, as estimated by Datos Insights. This could mean banks hold Bitcoin via ETFs or as collateral, quietly building reserves. Investors should note, this reduces risk for banks but might centralize Bitcoin, potentially leading to more control over prices. Point 3. Specific banks. Leading the charge. Who's accumulating and how? Let's name names. JP Morgan, the largest U.S. bank by assets, is a prime example. According to Bloomberg, reported in CoinDesk, JP Morgan plans to accept Bitcoin and Ether as collateral, starting with ETF exposures and expanding to spot holdings. This isn't direct buying for their balance sheet, but facilitates client accumulation, with the bank profiting from custody and lending. According to svb.com, At least 172 public companies hold 1 million BTC collectively, and banks like JP Morgan are enabling this. Next, Morgan Stanley. Per wealthprofessional.ca's January 2026 report, they filed for a Bitcoin trust and Solana trust, holding underlying assets and even staking for rewards. This marks the first major bank-sponsored crypto ETFs, signaling quiet accumulation through product sponsorship. Continuing, PNC Bank made history in December 2025 by offering direct spot Bitcoin trading to private clients, as per ccn.com. U.S. Bank resumed institutional custody in September 2025, partnering with NYDIG. Wells Fargo, Citi, and Goldman Sachs offer Bitcoin exposure to high-net-worth clients, per Yahoo Finance's January 2026 article. Even Bank of America recommends 1.4% portfolio allocations to crypto. According to Investment News, this follows Vanguard's reversal on crypto ETFs. From X posts like CZ Binance's tweet, "While you were panic selling, U.S. banks were loading up on Bitcoin, this narrative is gaining traction." Data from Glassnode, cited in Forbes, shows broad-based Bitcoin accumulation across wallet sizes, with institutions buying dips. Quietly? Yes. No press releases, just filings and partnerships. For instance, SoFi offers direct trading, emphasizing bank-level confidence. This accumulation via services could total billions, as banks custody $2 trillion in assets, per OCC data in Forbes. Pros: safer access for investors. Cons: higher fees and less decentralization. Point 4. The U.S. government's role, a massive holder influencing banks. While focusing on banks, we can't ignore the elephant, the U.S. government. According to Wikipedia, the U.S. Strategic Bitcoin Reserve, established by executive order in March 2025, holds 328,372 BTC, the world's largest state stash. Funded by forfeited assets, it prohibits sales and explores neutral ways to acquire more. According to Wikipedia, this ties to the Bitcoin Act, proposing 1 million BTC purchases over 5 years. How does this relate to banks? Regulatory easing, like no prior approvals for crypto activities, encourages banks to mirror this by holding or custodying Bitcoin. Elaborating, the reserve strengthens Bitcoin's legitimacy, signaling to banks it's a strategic asset. Per VanEck's calculator, if the U.S. accumulates 1 million BTC by 2029, it could offset $21 trillion in debt by 2049, assuming 25% annual growth. Banks benefit. The Genius Act allows stablecoin issuance, integrating Bitcoin into systems. X posts from users like Pumps and Pie Crypto highlight Wells Fargo's $383 million Bitcoin buy, though likely via ETFs. This government backing quietly pushes banks to accumulate, as seen in SVB's prediction of record M&A in 2026. Institutions poured $37 billion into ETFs in 2025 per ledger, but government holdings dwarf that. For investors, this means stability but potential manipulation risks if centralized. Point 5. Pros of bank accumulation. Why it's good for Bitcoin and you. Banks bringing their muscle to Bitcoin has upsides. First, legitimacy. Mainstream adoption drives prices. Standard Chartered forecasts $150,000 Bitcoin in 2026, per CNBC. According to CNBC's January 2026 prediction, this is due to institutional inflows. Second, accessibility. No more sketchy exchanges. Trade Bitcoin in your bank app, like PNC's service. Third, security. Banks use institutional-grade custody, reducing hack risks. Ledger estimates 20–30% of Bitcoin lost to poor self-custody. Diving in, banks lower entry barriers for boomers and institutions. Per Bitwise, corporate Bitcoin holdings rose 40% in 2025. Banks like U.S. Bank offer custody, safeguarding assets. Lending against Bitcoin, as JP Morgan plans, unlocks liquidity without selling. Imagine borrowing dollars against your BTC. Quiet accumulation stabilizes volatility. Forbes notes institutional influence in 2026 sell-offs led to quicker recoveries. For the ecosystem, more capital means better infrastructure, like tokenized assets exceeding $36 billion in 2025, per CoinDesk. However, it's not all rosy. Fees could eat returns, and banks might prioritize profits over innovation. Point 6. Cons and risks. The dark side of bank involvement. Not everyone cheers banks' entry. Centralization. Bitcoin's ethos is decentralization, yet banks could control flows. Critics on X like ZinxBTC argue banks backing dollars with Bitcoin counters global shifts like China's gold accumulation. According to X post from ZinxBTC, US should dump gold for Bitcoin. Regulatory risks. While clarity helps, reversals could hurt. Remember SAB 121? Further, fees. ETFs charge 0.21% per Investopedia. Privacy loss. Banks require KYC, unlike anonymous wallets. Volatility persists. CNBC notes Bitcoin 30% below highs due to long-term holders selling to institutions. Quiet accumulation might manipulate markets. Whales buying dips while retail panics, as per Glassnode data in Forbes. For small investors, this could mean higher barriers if banks favor high-net-worth clients. Ethical concerns. Boston Review's February 2026 article warns crypto interests amass $250 million for 2026 elections, potentially buying influence. Point 7. Data and stats, proving the quiet accumulation. Numbers don't lie. Per earnpark.com, 60% of top 25 banks, 1525, offer Bitcoin services as of January 2026. Aggregate corporate BTC, 1 million coins, 5% of supply. Bitwise via svb.com. ETF AUM, 130 billion, wealthprofessional.ca. VC in crypto, 7.9 billion in 2025, up 44%, PitchBook and CoinDesk. Breaking it down, Glassnode shows accumulation across cohorts, with 100 BTC wallets aggressive buyers. Forbes. M&A. 140 deals in 2025, 59% jump. PitchBook. Stablecoin funding, $1.5 billion in 2025. CoinDesk. Predictions, Bitcoin 130K, 150K in 2026, Amina Group. These stats confirm quiet buildup, not flashy buys but infrastructure. Point 8, future implications. What 2026 holds for Bitcoin and banks. Looking ahead, SVB calls 2026 crypto's integration year. More banks will launch products. Morgan Stanley's ETFs could inspire others. Per YouTube transcript from How the Banks Are Coming for Bitcoin, banks like JP Morgan will issue credit against BTC in H1 2026, projecting institutional demand could hit $3 to $4 trillion with 2 to 3% allocations, Datos Insights. AI convergence, 40% of crypto VC to AI integrated firms, CoinDesk. Challenges, volatility as Bitcoin dropped 22% YTD, Yahoo Finance. Hybrid strategy, 60% in bank ETFs for safety, 40% self-custody for control. Point 9, investor strategies, how to play this trend. For you, diversify. Use bank services for ease, but hold some direct BTC. Monitor regulations. Genius Act compliance starts 2027. Point 10, conclusion, the quiet revolution. U.S. banks are indeed quietly accumulating Bitcoin exposure. For more, like, subscribe to Joseph Markets, comment your thoughts.